Welcome to Lecture 4. Today's topic is on the revenue cycle, and at the end of this lecture, you should be able to do the following. You should be able to describe key functions in the revenue cycle, to describe the flow of revenue transactions and its relevant documents, to analyze key risks in the revenue cycle, as well as to identify internal control procedures to address these risks.
Let's dive straight into Learning Objective 1 to describe the key functions of the revenue cycle. In Lecture 1, you learned that the revenue cycle comprises business activities relating to the sales of goods and services to customers and the related cash receipt transactions. This diagram provides a bird's eye view of revenue activities in a business organization. It usually starts with a sales order by a customer. Businesses usually sell goods on credit. Hence, once a sales order is received, the customer's credit status is checked. And if credit is approved, the goods ordered can then be arranged to be shipped out to the customer. The billing department will then prepare an invoice for the goods that have been ordered, and this is sent out to the customer. The accounts receivable department will record the credit sale in the accounting books. Normally, a 30-day credit is given. After this 30-day credit is up, payment is due, and the customer is required to make a payment to the business. It is important to note that in a credit sale, there is usually a time lag between the billing and the cash receipt from the customer. Hence, we will split the revenue cycle into two phases for better understanding. Sales order processing, which will include sales order all the way to billing and AR, and cash receipts on its own. Let's look at the flow of revenue transactions and some relevant documents in this cycle. Before explaining the key functions in greater detail, let's understand some key symbols and what they represent when looking at a data flow diagram. This symbol here represents an input source or an output destination of data. Entities that are in a data flow diagram represent objects that lie outside of the system. For example, a customer or a supplier. Now, this symbol here denotes a process that is triggered by data that is received. Now, for the purposes of this lecture, we have also included the department or the function which handles the process, and that's actually denoted by this N in the symbol. Now, this one little box here denotes a store of data, which in a manual system could be a journal or a ledger or even a customer file, but in a computer-based system, it is usually in the form of data that is stored in a transaction file, a master file, or a reference file. Now, this arrow here represents a data or a document flow in the direction of the arrow. Usually, when data flows into a process and out again, the data has in some way been changed. This figure gives an overview of the sales order processing system. Now, the diagram may look kind of intimidating, but let's study the data flow diagram part by part to understand the flow of the sales transaction and the relevant documents that are involved. Let's first focus on the sales order and the credit check functions. Now, the sales process begins with a customer contacting the sales department. This initial contact may be by telephone, mail, or even through internet order. The sales department then captures the essential details of the sales in a sales order form, which is usually prepared in multiple copies. The credit copy of the sales order is sent to the credit department to do a full credit check against the customer's credit records. Now, if the customer is new, a full financial investigation is done to determine the credit limit to be granted to the customer. For existing customers, it will check if the new order will exceed the credit limit. It is important to note that the credit approval serves as a transaction authorization. Now, once credit approval is obtained, the customer order file is updated with the sales order approval date. The approved sales order triggers the release of other sales order copies to various departments and functions. So you will have the stock release copy that's sent to the warehouse, the packing slip and the shipping notice that is sent to the shipping department, as well as the invoice copy of the sales order that is actually sent to the billing department. Now we will look at how these documents are used in the various departments and functions in the next slide. Let's now look at the picking and shipping function. The stock release copy of the sales order provides a formal authorization for the warehouse personnel to release custody of the specified goods. The stock records in the warehouse are updated to reflect the reduction in inventory. Take note that this is not the formal accounting records for the inventory, as custody of assets and recording should be separated. Then the picked goods are then sent to the shipping department with the verified stock release form. With the packing slip and the shipping notice that is received from the sales department earlier, the shipping department reconciles the goods received with the stock release and the shipping notice. Now the shipping department prepares the bill of lading for goods that are shipped overseas, or the delivery order for local deliveries, and it then ships and delivers the goods together with the packing slip and the bill of lading or delivery order to the customer. And last but not least, the shipping records and the customer order file are updated to indicate the shipped or delivered date. The billing department plays a central role in sales order processing. It collects information about sales transactions, reconciles the sales order with what has been delivered, and then issues an invoice to the customer and updates the sales journal. Upon credit approval, the billing department receives the invoice copy of the sales order from the sales department. This document is kept in a pending file until they receive the shipping notice and stock release documents from the shipping department after the shipment of goods. When the goods have been shipped, the shipping department sends the shipping notice and stock release document to the billing department. Here, the billing staff then retrieve the invoice copy of the sales order from the temporary file and reconciles the information. When all the information is in order, the billing staff then prepare the sales invoice and sends this to the customer. A copy of the sales invoice is then sent to the AR function for an update to the AR subsidiary ledger. Now the sales details will then be updated in the sales journal, while the stock release details are used to update the inventory subsidiary ledger. Take note that the billing department waited for documents from the shipping department before they sent the invoice to the customer. Do you know why? This is an important internal control to ensure that customers are only billed for items that have been shipped or delivered. Posting to the general ledger is done either at end of day, end of week, or end of month, depending on the size of the company and sales transaction volumes. At regular intervals, the GL function will receive the various documents from the AR function, the billing department, and the inventory control function to facilitate the posting to GL. Now the billing department will prepare a journal voucher to record the total sales amount from the sales journal. The GL function will check the total sales figure in this voucher against the AR summary that's sent from the AR function before they post it to the GL. Now the double entry that is used to record credit sales, if you remember this in FA2, is to debit the AR control and to credit your sales. Now likewise, The inventory control function will prepare a journal voucher to record the total reduction in inventory from the sales, and this is sent also to the GL function. And in this instance, your double entry is to debit your cost of goods sold and to credit your inventory. Now, once the journals have been posted, the journal vouchers will be filed accordingly, and the accounts in the GL will also be updated after the posting. We have just reviewed the functions of the sales order, credit check, shipping, billing, and AR, and the respective updates to the GL of the credit sale. Now let's see if you can answer this question. Let's now review the cash receipts function in the revenue cycle. That is, the receipt of cash from the customer in payment of the accounts receivable. Now this figure gives the overview of logical activities in the cash receipts system. As with the sales order system, we will review the data flow diagram part by part to understand the flow of the cash receipt transaction and the relevant documents in the cash receipts system. Very briefly, the cash receipts procedures involve receiving and securing the cash or the check, depositing the cash or the check in the bank, matching the payment with the customer and invoice outstanding, and properly accounting for the cash receipt transaction in the GL. The cash receipt transaction starts when customers send in the checks, accompanied with the remittance advices via mail. As learnt in Lecture 1, the remittance advice is a turnaround document that can be detached from the invoice and contains invoice details. Now this helps the company identify which invoices are being paid with the checks received. Note that a mailroom is the place in an organization that receives all mails. As a variation, many small firms may not have a mailroom. Instead, they assign one staff to receive all incoming mails for the firm. Now, some firms assign this task to the receptionist or the admin clerk. Now, the mailroom employee then records each check onto a list called the remittance list, which is prepared in 3 copies. Now, the original copy of the remittance list is sent together with the checks to the cash receipts function. Copy 2 of the remittance list is sent together with the remittance advices to the accounts receivable function. And copy 3 of the remittance list goes to a reconciliation task. With the checks and remittance list received from the mailroom, the cash receipts clerk verifies the accuracy and completeness of the checks against the remittance list. Any checks possibly lost or misdirected between the mailroom and this function can then be identified. After reconciliation, the cash receipts clerk will record the receipts in the cash receipts journal. He then prepares a deposit slip showing the amount of the day's receipts and forwards this along with the checks to the bank. At the end of the day, the clerk summarizes the cash receipts transactions in a journal voucher to the GL function. Periodically, a clerk who is not involved in the cash receipts function will reconcile the cash receipts by comparing the following documents: a copy of the remittance list that's from the mailroom, the deposit slips that have been received from the bank, and related journal vouchers. The reconciliation task serves as an independent verification procedure to ensure that all cash receipts are properly accounted for. The remittance advices received from the mailroom by the AR function are used to update the customer's accounts in the AR subsidiary ledger. Note that as the AR update is a recording function, the AR clerk does not have access to the physical checks. Periodically, the changes to the customer account balances are summarized and forwarded to the GL function. Upon receipt of the journal voucher from the cash receipts function and the AR summary from the AR function, the GL function will reconcile the figures and then post to debit cash and credit AR control accounts. The journal vouchers are then filed accordingly. Now that we've finished looking at the cash receipts function, let's try answering this question. Now that you have understood the key functions, transaction and document flows in the sales order system and cash receipts system of the revenue cycle, let's review the key risks in the revenue cycle and the important internal control procedures to be put in place to address these risks. Do recall that an objective of internal control is to mitigate the risks from errors and fraud. The following are primary risks associated with revenue cycle transactions. They are selling to uncredit-worthy customers, shipping customers the wrong items or incorrect quantities, inaccurately recording sales and cash receipts transactions in journals and accounts, the misappropriation of cash receipts and inventory, and the unauthorized access to accounting records and confidential reports. Now, to mitigate each of these risks, we will be discussing the relevant internal control procedures, which can be in the form of physical control activities or in the form of IT controls. Let's do a recap of the two categories of control activities, which can be in the form of physical control activities or in the form of IT controls. Physical controls are controls which relate primarily to human activities employed in the AIS. There are 6 physical control activities. They are transaction authorization, segregation of duties, supervision, access controls, accounting records, and independent verification. IT controls refer to controls which relate to the computer environment. In a typical transaction processing system, there are input, processing, and output controls. It was mentioned earlier that there are 5 key risks in the revenue cycle. The first risk is selling to uncredit-worthy customers. Selling on credit to customers who have not been properly vetted could lead to excessive bad debt losses. This risk is more apparent in organizations whose sales staff are compensated on a commissions basis. So let's review the important physical controls and IT controls to mitigate this risk. There are 2 physical controls that can be implemented. The authorization process in the sales function is a credit check of the customer. This task is a function of the credit department, and it is to ensure that credit checks are done on the customer before approving the sales. To provide independence to the credit authorization process, the credit function should be separated from the sales function, or what we know as transaction processing. Now, this will prevent sales staff from forcing through a sales transaction without a credit check at the expense of high bad debts. Now, IT controls can come in the form of automated credit checking, whereby a program is built into the system to do the credit checks based on the customer's credit history in the database. If credit is denied, the sales staff should not be able to force the transaction to continue. Shipping wrong items or quantities to customers may result in damaged customer relations, excessive sales returns, lost future sales, and accounting errors. Now, these risks may be due to human errors in picking up items from the warehouse or because of unanticipated inventory shortages known as stock out situations due to poor inventory tracking. To prevent the shipping of wrong items or quantities, independent verification by the shipping function is important. It should verify the goods sent from the warehouse are correct by reconciling the stock release document that's from the warehouse with the packing slip that is from the sales order. IT controls may be in the use of scanner technologies and automated inventory ordering. Products code scanners can reduce the risk of human error in picking and shipping incorrect products. When scanning, the system will verify that items selected match those on the sales order. When an inventory recorded is updated to reflect a sale, the computer logic should check to determine if the reduction in quantity drops the quantity on hand to below the reorder point. And if so, it should trigger a purchase of inventory from the supplier. This will prevent stock out situations, resulting in being unable to ship the customer's order. Inaccurate record keeping can take many forms. They include the sales being inaccurately calculated, customers billed for items not received, and cash receipts posted to the wrong customer accounts. The physical control to mitigate the risk of recording cash receipts incorrectly is to have the mail room clerk prepare a remittance list as a means of verifying that customer checks and remittance advices match in amounts and represent valid transactions. In the area of proper accounting records, the use of pre-numbered documents helps to provide a unique identification for each document, and this facilitates in tracing transactions and verifying financial data. Of course, all accounting records, such as journals and ledgers, must be properly kept, as they serve as an audit trail that allows auditors to trace transactions through various stages of processing. Another important physical control is independent verification. The objective of independent verification is to verify the accuracy and completeness of tasks performed by other functions in the process. For example, the shipping function reconciles goods shipped against the packing slip to ensure correct items are being shipped out, while the billing function reconciles the sales order with the shipping notice to ensure that correct billing is sent to customers. The GL function, on the other hand, reconciles journal vouchers with summary reports from the AR and inventory control functions before these transactions are posted to the GL. An important input control in any transaction processing system is data input edits. They are programmed into the system to minimize the risk of data input errors. For example, checks can be done for any missing data or invalid data values in data entry for the sales order, AR, inventory control, and billing. Automated posting from the AR to the GL will not be new to you. You will personally see how this is done when you post your invoices in the Sage AR system. And by eliminating the human element from such accounting activity, the potential for errors and opportunity for fraud are significantly reduced. Finally, file backup is an important IT control in ensuring the integrity of digital accounting records. Any data loss, destruction, or corruption can be recovered with proper file backup procedures at regular intervals. Cash and inventory are the physical assets at risk in the revenue cycle. In the absence of proper controls, cash receipts is at risk of being embezzled, and inventory in the warehouse is at risk of being stolen. Physical controls to mitigate the risks include proper transaction authorization, supervision, access controls, and segregation of duties. In a computerized environment, the segregation of duties are accomplished through multi-level security procedures that limit access to authorized processes and data. For example, a staff assigned to particular roles cannot access program procedures and data that are not specified for that role. Accounting information is at risk to unauthorized access to outsiders and employees of the organization. The motives for accessing information include attempts to perpetrate a fraud, such as creating a false sales order, the theft of data, such as stealing a customer list for a competitor, or malicious acts, such as corrupting financial data. Physical controls include limiting access controls to source documents and accounting records, and having proper segregation of duties, whereby certain record-keeping tasks are separated. IT controls can be in the form of having passwords and multi-level security to prevent unauthorized access to computer files and programs. Before we conclude this lecture, let's watch a video which provides a quick summary of what we have discussed today. Well, congratulations! You have just completed Lecture 3. Let's summarize the key functions and documents in the sales order system by reviewing the functions and the key documents that flow in and out of each of the functions. This slide summarizes the key functions and documents in the sales order system. This slide shows the key functions and documents in the cash receipts system. The other important concepts learned are the key risks in the revenue cycle and the relevant physical controls and IT controls necessary to address the risks. This slide summarizes the physical controls and IT controls for the first 3 risks. This slide summarizes the physical controls and IT controls for the remaining 2 risks. Now that you have learned the important concepts in the revenue cycle, you are now ready to attempt the tutorial and quiz. All the best!